Jim Simons perceived the financial markets not as a chaotic tumble of news and sentiment, but as a vast, elegant system of mathematical patterns, akin to natural phenomena. His journey from child prodigy to the most successful investor in modern history is a testament to the power of applying pure intellectual curiosity to the practical world. From a young age, Simons displayed an innate, almost instinctual grasp of numbers, puzzling out Zeno's paradox on a family car trip. This pattern-seeking mind would define his path, leading him away from conventional careers and into realms where few had dared to apply rigorous mathematics. After excelling at MIT and Berkeley, a brief, sockless stint teaching at Harvard left him restless. He found a more stimulating challenge at the Institute for Defense Analyses, a Cold War think tank, where he joined other brilliant mathematicians in the task of cracking Soviet codes. Here, Simons honed the skill of finding signals in noise, developing algorithms to decipher patterns from seemingly random data. This experience was foundational, proving that complex systems, whether encrypted messages or, he would later hypothesize, financial markets, could be decoded. Yet, even the thrill of intelligence work wasn't enough. Concurrently, his work in pure geometry flourished, resulting in groundbreaking research on minimal surfaces that cemented his academic reputation. But Simons was drawn to a new puzzle, the market. He began to develop a theoretical model that treated price movements as a system with distinct, probabilistic states, disregarding traditional analysis of companies and economies in favor of raw, mathematical pattern recognition. Fired from the IDA for his opposition to the Vietnam War, Simons returned to academia, but found his ambition pulling him elsewhere. At 40, he made a leap that baffled his colleagues, founding a hedge fund management firm called Monometrics. Partnering with Leonard Baum, co-creator of the influential Baum-Welsh algorithm, Simons aimed to apply predictive modeling to currencies. Their early office, papered with charts, was the humble birthplace of a revolution. They succeeded spectacularly, with one early coup involving a prescient bet on the British pound. Simons later renamed his flagship fund Medallion, after a character in a Joseph Conrad novel who wins a gambling medal, a fitting symbol for his belief that the market was a game of skill he could master through mathematics. The true transformation began when Simons fully embraced computing. He realized that human intuition was a bottleneck. The future belonged to models that could process vast datasets without emotion. He began recruiting not from Wall Street, but from universities and labs, assembling a unique team of physicists, astronomers, and statisticians. This band of quants built complex, automated trading systems that sought subtle correlations across global markets, executing thousands of trades at speeds and scales impossible for humans. The Medallion Fund's performance became legendary, generating returns that dwarfed those of traditional investors, and even the famed Warren Buffett. Simons enforced a culture of intense secrecy, compartmentalizing research to protect the firm's intellectual secret sauce, which was less a single formula, and more a relentless, scientific process of hypothesis, testing, and refinement. Simons's career intersected with that of Robert Mercer, a brilliant but controversial computer scientist whose work on speech recognition and political data mining would later influence realms far beyond finance. Under Simons, Renaissance technologies became a fortress of data-driven profit, but it also attracted scrutiny for its opaque methods and tax strategies. Despite the controversies, Simons's legacy is profound. He demonstrated that financial markets are not purely efficient or random, but contain faint, mathematically discernible signals. After stepping back, he turned his fortune toward philanthropy, funding basic scientific research and education with the same zeal he once applied to trading. His life story redefines the archetype of the investor, proving that the tools of abstract mathematics and computational science could solve the ultimate practical problem, predicting the seemingly unpredictable flow of money.